It's not bad, it's not great. I think it feels like a win, but it's not a victory if you're a bull. It's very simple, I'll say it again. It feels like a win, but I don't think it's a victory. Win is when you get one small patch right. Victory is like the markets have decisively turned. Trust me, nobody can decisively thumb the table, excepting the person who's sitting next to me, Sridhar Sivaram, that what will happen to markets from here because of coronavirus. That is a great introduction. Now you better live up to the introduction. What was going to happen to the market?
So none of us are experts as far as this uncharted territories. But having said that, I've at least attended a few calls with experts. And the most interesting one was Dr. Jeremy Ferrar, who's expert on tropical medicines and infectious diseases, and who's somebody who's worked on SARS and H1N1. And so I'm going to repeat what he said. Basically, it's somebody who knows rather than me trying to speculate. Sure. And his view is that 30% of global population will get affected by this virus. But the positive news is that the fatality is only around 1%. Currently, the fatality is much higher, but the fatality could be closer to 1%. What this can have, the impact on global economy is much more significant than what we are anticipating if what he is suggesting is correct.
Are you believing what he's saying?
I am believing what he's saying.
So then what is stopping you from selling everything and going away? Because if 30% of the world will get affected and economy is going to take a tank, then markets will be headed lower.
But when you get, correct. So what happens is that when you get a recovery, it's going to be a V-shaped recovery. So my view on the market based on this is that 2020 is going to be a very tough year. Anyway, for India, it's a tough year. Look at the economic data. So it isn't as if we are here where the economy is, firing on all cylinders.
But Sridhar, sorry to interrupt you there, before the virus, the markets were completely ignoring all that was going on with the economy.
Yeah, that's because there was an expectation that this economy is troughing out and that you will see a recovery very fast. You put coronavirus on top of that, the recovery is pushed back. So you look at just the GDP number that was announced. The government is now saying that the fourth quarter is going to be lower than the third quarter. So I'm not suggesting this is what the government's data is suggesting, because your average number is 5%. The only way the average comes is if your fourth quarter is going to be lower. So which is why I'm saying that given all the data that you have, even for a second, I assume that the doctor is wrong. It isn't as if the economy is firing on all cylinders. So even if you miss 10%, it isn't much that you're missing. You're better off being very cautious right now, being very sure what you're buying. And I think it's become really a bottom-up market. So if you want to pick and choose stocks, you're better off, picking your price and buying some of those rather than being very brave right now and buying everything just because there is a global rally or there is a global dip. We are seeing very volatile markets. We saw last 1 week has been as volatile as one could have imagined.
So would you just be juggling between existing holdings, or would you actually be buying fresh into what you're suggesting are good quality names?
Yeah, so I think it's a combination of both, right? So if existing holdings, suppose correct, obviously if my conviction is very high, I would want to add. And there are stocks which may have rallied a lot, we may have missed. So I think it's a combination of both. Yeah. But I think the better way of putting it is that one has to do a lot more homework today and be very sure that you've done enough work before buying.
But, just to pick up on what you said, you again said the ones that you've missed out on, the ones that have rallied. And I think the question we've all been asking is, what about the beaten down names? What about the ones that no one seems to be looking at?
So our view is that broader markets will do better this year than the 10 stocks that have done very well. I'm not suggesting that those 10 will not do well. But you'll make, probably when the dust settles down, you'll make disproportionate money from broader markets than those 10 stocks.
Why? Just what I'm trying to understand. I mean, if one really works with a reasonable, logical thesis, growth will be slow. Growth will be precious, both locally and globally. We had our own set of problems before the virus issue, and now those problems only have got multiplied, which means few companies will do well.
Yeah.
If that is the case, that few companies will do well, and every data point which you would now look at, both locally and globally, will take it with a pinch of salt.
Yeah, so there are two ways of looking at it. One is that market works on the delta of growth. So currently, many of these stocks, just take auto as an example. I mean, we are just assuming that auto growth will be negative for a very long period of time because Now their valuations are well below even their long-term averages. Obviously, auto in India is having own set of issues. We have BS6 transition coming up. Once the dust settles down, we'll see some sort of growth coming back. The probability that you get a sharp move here is much higher than many of the other growth stocks. And keep in mind that the growth stocks are building in some sort of an assumed growth. When you get a disappointment in that, and we've seen with some of the growth stocks where growth disappointed, they corrected more than 50% last year. So you could easily see if the growth disappoints, then you could see either an underperformance or a stock price disappointment in both. So I think it's a very fine balance, which is why I said that I'm not saying that those 10, 15 stocks will not do well, but the probability that you will make more money out of maybe the rest of the basket, not all of them, but if you are able to pick and choose based on certain assumptions, your probability is higher. It isn't an easy job, but I would bet that I will make more money there.
But tell me, I can't get that 30% world population getting impacted out of my head. So I'm just going to go back to that.
Sure.
Do you think with last week's price correction and thereof the 7.5% damage on the Nifty bigger for the broader market, are we out of the woods? Because if it's really 30% of the population of the world which is going to get impacted, I mean, this is just a tip of the iceberg, it seems.
So I will repeat what he said. 30% impacted, but that is not the fatality.
Obviously.
Okay, so the fatality rates are much lower.
Infected, yes.
Yeah, so you could get infected. So it's like a flu. I mean, many people get a flu, but this is much more serious than that because of the way it spreads. So as we've seen what has happened to Italy, we wouldn't have expected it to be in Iran. It spreads much faster than what people anticipate. Which is why I said that this is not a time to just go and bottom fish, because honestly, none of us know much about it. So I am basing my view based on some expert who's actually working. So the other important thing he said, there is no vaccine till 21.
Yeah.
Okay, so there is an expectation that there's a vaccine which is coming around the corner. The first test is happening as we speak. This is the first clinical test at the very early stage. So there isn't any vaccine.
Cure.
Yeah, there isn't any vaccine coming till 21, maybe mid or late 21. So just to put things in perspective, and as I said, I'm repeating, these are not my views. These are experts' views who are actually working on these vaccines. So based on that, I'm saying that one has to be cautious.
So in this context now, we've got the G7 call today. If we do see some kind of calibrated easing or measures by central banks around the world, what's the kind of stimulus?
No, I think we will see. I mean, that's bound to happen.
I mean, we were speaking to Mobius yesterday as well, and he said there's enough room, they have to act, and I guess the bigger question is what's the kind of impact?
Yeah, so it will have, but incrementally you'll see that these will start to have lesser and lesser impact. The ammunition left with central bankers is very limited, but they will act. And we will see a global synchronized, sort of easing on this. But so will be the slowdown in growth. Keep in mind that, the entire China supply chain is disrupted. Global travel has been disrupted. The impact that this has on, the spending that happens because of this has stopped. So the global growth will come down. There is no debate on this. The question is how much and for how long. So if it is more than 2 quarters, then we have an issue. If it is, say, just 2 quarters, then we'll remember this as SARS in 5 years to come.
But tell me, what is it that we're looking at when it comes to India? I mean, are we going to see further easing by RBI? Does the government have the ammo, which, up until the budget, you thought they don't have any ammo to spend more? They're still grappling with divestment and what have you. Can they really pump in stimulus if the economy needs so, which clearly it would?
I think fortunately India has the leeway. So if you look at central banker, at least RBI hasn't cut rates in the last
2 times. Yeah.
So there is ammunition, and keep in mind that India's inflation was predominantly vegetables, and that too predominantly one or two of them. So, and we know that with good rainfalls, that is coming off. So I think India has ammunition. Even on the fiscal side, India has, because the government, in my view, should have kept it at 3.8. They went at 3.5, the fiscal deficit. At least 30 basis points leeway is something that I think the government has. So if suppose there is a crisis, I think India is better prepared today because we haven't fired all our bullets and we are keeping a lot of them in store right now. So it could be possible that we use some of them to cushion some of the shocks which can come globally.
Okay. As a house, we know you bought into telecom not yesterday, not a month ago, about a year and a half ago.
Yeah.
When old timers and smart guys, when they bought into telecom, the thesis was these rates will not continue. Industry has to normalize.
Yeah.
The industry has normalized, but guess what? There is this dreaded word now, AGR.
Yeah.
How do you view telecom stocks and telecom sector moving because of AGR issue?
Yeah, so I will just first give a broad 360-degree view on telecom and how we look at it. 2.5 years back, industry revenue was 2 lakh crores. Last year, that number was 1,50,000 crores. So you've seen a 50,000 crore erosion in the revenue of the telecom sector at a time when data usage is up 10 times, minutes of usage is up 30 times, number of users are broadly give and take about 10% higher. All we are saying is that this number will go back to the 2 lakh crores today or tomorrow. We don't know when. That's the broad game. So if you take, say, 50,000 crore incremental EBITDA and you give a 10 times EV EBITDA to that, that's a 5 lakh crore additional market cap to the sector.
Okay.
Now you can decide who gets what. That's the broad thesis. I'm giving you a very top-down thesis. And then you put all these AGR issues. Now, if these AGR issues have come, you have to reduce because the companies will have to take that much more debt. And maybe one player becomes lesser. So if that happens, then the two of the others benefit. So I think that's the broad view I'm giving. I will not get into the nitty-gritties. We are still very positive on the sector.
So still buy on declines for a Bharti.
I would say it's a sector which is...
SBI Cards.
So I'll give you a very macro view. I'll not speak on cards or SBI cards in specific. If there is one segment within financial sector which is getting disrupted as we speak, is the cards business. So look at the number of people who are there, global majors who are there, from Facebook to Google to Alibaba to possibly even Jio. I will give you a statistic from China that the average card spend in China is $1,300 per person.
$1,300
per person per year. India is $2,000. India is higher than China.
Really?
It doesn't end there. US is $3,000. Why did so China was more than 2,000, it fell to 1,300. Why did it happen? It happened because the payment segment got disrupted there thanks to WeChat and Chat and Alipay. So today it is QR code only in China. So if you go to China, everything is on the mobile.
Yeah.
So and the other thing that has happened thanks to Alibaba is that credit is becoming very easy even on the QRs. So you make a payment, you immediately get an option, you want to pay by credit or you want to pay immediately. My simple point is that when there is any disruption in the market, there is something called anxiety of disruption for investors. We've seen that with media. We've seen that with telecom. With telecom. We've seen that with many other sectors. Autos is the other classical example, where even before it gets impacted, the sector gets derated. I'm just giving a warning here.
The flip argument here is, again, purely based on global data, look at the market cap of Visa and MasterCard. They are also platforms.
Yes.
They also will make money when credit card transactions will go higher. So while the Chinese data is a declining data, the market cap of Visa and MasterCard during that same period is up some 9-10x in last 10 years. So China or US?
So we are actually comparing a very wrong data, right?
Okay.
The disruption is happening as we speak. The only country that has actually got disrupted is China. There isn't any country. If you ask me the probability of the second country to see similar disruption, I would say thanks to UPI is India. So you need to speak to Nandan on this to understand what his views are on disruption on UPI. So credit on UPI is already launched.
Credit on UPI has been launched. Yes.
Already launched.
Beam is doing very well.
Yeah, so the day, WhatsApp Pay is launched, and we know there are many vested interests who don't want WhatsApp Pay to launch, but the day WhatsApp Pay is launched, we'll see the first round of investor anxiety on disruption.
Okay.
So that's my word of caution. It's a great company. I'm not, the entire sector is great. You're making a lot of money, but possibly waiting to get disrupted.
You know, I'm archiving your comment because this is the most differentiated view which I've got.
The only differentiated view.
Yeah, I mean, it's a great point.
But I'm giving you view based on data. So I'm not suggesting, I'm not even for a second suggesting that's not a great sector. my only point is when I have met these companies and I've questioned them on disruption, some of them have admitted to me that there will be no physical card in 5 years and we will cross the bridge when it comes. But I have to cross the bridge today, not when the disruption happens. So I'm just saying that if valuations are not in my favor, I mean, I have enough and more to buy today in the financial sector. I don't have to chase everything, right?
Right. You know, just playing devil's advocate here, and since yours is the only differentiated view in the market, perhaps, on SBI Cards, A is penetration when it comes to a country as large as India, and the B is, you know, taking personal credit on personal balance sheet, which a UPI doesn't allow that even for a month, which a credit card does.
Which is changing right now, which is what I said. The credit on UPI is now getting launched. So in China, it's already launched. So it is already there where when you're making a payment on say a platform like Alipay or WeChat, you immediately get credit. Many of them are getting launched. Keep in mind that Alibaba is there in India and they're trying to replicate exactly what is happening. So China is a QR code market. And I think it's not too far that India will also move in that space. I'm not saying or suggesting that there isn't space for everybody, but like we saw with landline and mobile, India's landline penetration, say 15 years back, was only 3%, and mobile was just about starting. You could have made the same argument that landline penetration is only 3%, mobile is coming, so what? This 3 will go to 10, and mobile will also survive.
Along with it, yeah.
We know after 20 years what happened to landline. I'm not suggesting the same, but I'm just saying that payment is getting disrupted. And I'm worried that there are global players here with deep pockets. I mean, tell me which other segment has Google, you have, Alibaba, and you have Amazon.
And
plus
maybe
you
a
have
Facebook Pay, who knows?
Facebook, plus possibly Geo. Tell me all of them put together have more spending power than many of the others. Plus you have UPI. So they are all coming back. So I'm not even for a minute suggesting that payments, that credit card is not a great business. I'm only suggesting that it could get disrupted. So be very careful in your exuberance.
Fair point. Well, that's a differentiated view. I really appreciate that. I may disagree, but that's the joy of market.
Of course.
We must agree to disagree.
Sure. I mean,
There's always a buyer and a seller.
Yes, exactly.
All right. Really appreciate your time and thank you for joining us.